To achieve any goal, it's a good idea to first figure out where you're headed. And to reach an amazing goal like $1 million, you need to double down on understanding where to start. Hello friends, in this video I'll share with you a practical tool, a calculator for building wealth and generating passive income. Using this tool, you'll be able to calculate how much capital you can build and within what time frame, based on various investments, your financial situation, income level, and more. So, let's dive into the tool. It's built in Excel, making it accessible to everyone. There's a link below the video where you can download this template completely free. So, here's the capital building calculator. Let me quickly show you how to download this template. There are two options. The first option is to go to the menu, select File, Download, and choose the Excel format. The second option is to make a copy on your Google Drive and work with it there. To do this, select File, Make a Copy. Alright, let's get started. The first step is to fill in the initial parameters in the table. These are the input data you have right now, and will use as the starting point for your journey to saving $1 million. The first important thing here is the starting capital. This is a key parameter that determines the subsequent figures. You'll notice this as you play around with different options. However, be sure to enter the actual amount you currently have. For example, it could be $1,000, $10,000, or $100,000, and you'll see how the data changes accordingly. Naturally, the more money you have at the start, the greater and faster results you can expect, as this money begins working for you immediately. Okay, we've entered the starting capital. The next item is monthly income now. There could be different approaches here. Some may calculate the total family budget, while others calculate income separately from their spouse. Of course, you can try calculating different combinations of options. Let me enter the median salary in New York as an example. The median is more accurate and closer to reality than the average. As of today, the median salary in New York is $66,000 per year, which translates to $5,500 per month. I'll enter this figure. The next important item is expenses. If you've never tracked your income and expenses, open your banking app and export your transaction history for at least the past 3 months. Of course, it's important to pull data from all your accounts if you use multiple apps. At this stage, many people might notice an unpleasant reality. Expenses often equal income, and in many cases, expenses even exceed income. This means the budget gradually goes into the negative each month. I won't dive into the depths of financial principles right now, but even if your expenses are higher than your income, try applying the principle of pay yourself first. In our example, I'll enter expenses as $4,600, with the remaining amount allocated to investments. As you can see, all the entered figures are displayed in the table below, and this row here calculates the delta, the amount of money you're directing monthly towards building capital. Alright, let's move on to the expected annual income growth. Suppose you're working a salaried job without actively improving your qualifications or skills. Even in this scenario, your salary will likely grow very slowly. However, this growth is unlikely to outpace inflation, but that's a topic for another time. Now, let's assume you're making some effort to enhance your skills, take on additional responsibilities, or work extra hours. In this case, your expected annual income growth could realistically be 10% or more. The next key input parameter is the expected return rate on your investments. It's important to note that as your capital grows and your experience as an investor increases, this rate will likely improve. For example, for most people, the initial annual growth rate will be roughly equal to the average rate of a bank deposit, which is currently around 5%. However, in the future, you'll likely start using more advanced and higher-yielding investment tools, and this rate will increase. Now, as you can see in these cells, you can observe how your monthly income changes based on different annual return rates. Inflation. To start, I recommend calculating everything with zero inflation so you can understand the absolute figures and what to expect over time. Then, recalculate with the inflation rate you anticipate. For instance, you can use the average inflation rate from the past couple of years as a reference. Recalculating with inflation will help you understand what your capital will look like in a few years, adjusted for current prices. As unfortunate as it may be, all money, even the dollar, loses value over time. After entering the initial parameters, we move on to the calculations. Let's break down what each element represents. Here, you'll find the years. The table is calculated for 25 years. A graph of capital growth is automatically generated here. Income is taken from this cell, and you can adjust it only in the input data. expenses are also taken from the input data. Delta is straightforward, the difference between income and expenses. Accumulated capital for the current year is calculated as the delta, how much we save monthly, multiplied by 12 months. This shows how much capital we will save in a year and direct toward investments. Capital from the previous year shows the capital accumulated from prior periods. The first cell uses your starting capital, and subsequent cells are calculated using a formula. Interest on capital from the previous year is calculated by applying the expected return rate to the capital at the beginning of the year. This shows how much income is generated from the capital you already have. Interest on capital for the current year. Don't forget that the delta also continues to work for us. However, here we calculate it differently. We multiply the delta by the expected return rate and divide it by 2. Why? Because the money invested at the beginning of the year in January will work for 12 months, while money invested later in November will work for only 2 months. To average this, we use this formula. It might not be super precise, but it's sufficient for a basic calculation. Finally, this cell shows the total capital at the end of the year, which consists of accumulated capital for the current year, capital from the previous year, interest on capital from the previous year, interest on capital for the current year. Alright, let's move on to the second year. Our income is growing by the specified percentage shown here. Expenses, naturally, these will grow alongside your income. In this simplified model, they are tied to inflation. Let's assume that our income grows by 10% while expenses grow by only 5%. As you can see, everything is updated in the table. This is how income and expenses will change with these growth rates and this level of inflation. However, don't fool yourself. If over the past 5 years, your income has equaled your expenses, or if your income has only exceeded your expenses by 1-2%, then enter that as it is. In such a case, you'll notice that the delta increases monthly, and with it, the accumulated capital for the current year. The capital from the previous year is pulled from this cell, and the remaining values are recalculated proportionally. This way, we can understand what results to expect in 5, 6, 7 years and so on. With our input parameters, in 15 years, we can expect a capital of the desired $1 million, or even a bit more. But if we change any of the input values, the numbers adjust accordingly, as shown here. Now let's take a look at the potential passive income section. What is it? This is the amount that shows the passive income you can expect. For example, let's assume that in 10 years, we'll have a capital of $518,000. Here, you need to input the rate of return for generating passive income. I've entered the average growth rate of the US stock market. Naturally, this number will vary for everyone. Some might simply put their money in a savings account at 5% annual interest. Others might invest in bonds and achieve 15% or more, and so on. Based on this, in 10 years, a capital of $518,000 could generate approximately $51,800 per year, or around $4,300 per month. Using this table, you'll be able to understand what you can expect. For some, this might be a cold shower, revealing their actual financial situation. For others, it may show very positive prospects over the next 5-10 years. Don't forget that the compound interest formula is definitely at work here. For example, in the first 5 years, our capital might grow to $121,000. But in the next 5 years, totaling 10 years, that amount could grow to $518,000. That's exponentially more. This is the magic of compound interest. You can also identify the point at which your passive income might equal your active income. However, I would recommend using this table to understand where, how, and what you can adjust to accelerate your progress toward your goal. For example, what if I can earn more each month while maintaining my current level of expenses? How quickly will I reach my goal? Or what if I can increase the return rate on my investments? It's important to always remember that even the simplest plan is better than having no plan at all. Of course, things might not go exactly as planned, but having a clear understanding of where you're headed and how to get there makes everything clearer and more engaging. A small tip: you can create 2 versions of this table, one called Plan and the other Actual Results, and compare the numbers at the end of the year. This way, you can identify areas where discrepancies arise and determine where to focus more effort. Did you find this table useful? Is there anything you think should be added or changed? Let me know in the comments below the video, and don't forget to subscribe to my channel and give it a thumbs up.